This is fascinating. A lot more sellers than buyers.
It's getting scary out there for the housing market. Watch until the end of this video and you will be shocked. Don't forget to like and subscribe to this channel. And now let's jump right into it with this clip from Fox News.
Not a day goes by, right? I mean, warnings and concerns about the housing market, they're mounting. Now, this morning in my inbox, Political called this situation a lose-lose. And, well, there have been even more sensational headlines like this one from the Daily Mail saying that realtors have hit the panic button. Now, some parts of the market, the housing markets, have already crashed, folks. I mean, second quarter of 2025, what they call the vacant property zombie report, 1.4 million residential properties. That's up big time, 1.3% of all U.S. homes. So they're vacant, right? They're zombies. 13 consecutive quarters. Well, this number has been around that level. So, you know, obviously people drive through these neighborhoods. You see them, you know what we're talking about. And then, of course, this morning, we learned that mortgage applications were down yet again, third week in a row. And this is refis and purchases. Now, part of the problem is that there are now a lot more sellers. Look at this chart. This is fascinating. A lot more sellers than buyers. All right, 1.9 sellers, 1.45 potential buyers. Now, my next guest has the best insight that I've seen on the street when it comes to these numbers and really the nuance of these numbers. I want to bring in now Resi Club co-founder, editor-in-chief, Lance Lambert. Lance, welcome to New York. Welcome back to New York.
Thank you for having me.
Let's talk about this overall problem. For me, this is the stat that stands out most, right? Let's bring that back before we go to Lance's chart, because the more sellers than buyers, obviously the tables have tilted. It's a so-called buyer's market, and yet it doesn't feel like it.
Yeah, so what's occurred is that during the pandemic housing boom, there was so much demand that came in at once. Those ultra low rates, all the money that was printed, all the remote work, there wasn't enough supply in terms of units out there to meet that demand. So the demand all didn't get to transact and prices overheated. They soared. And so once mortgage rates went up 3, 4, 5, 6, 7, that reality of that deterioration became apparent. And so the market we're in now is slowly active inventory is rising. Completed unsold new construction is rising, and the power dynamic is moving more and more from sellers to buyers.
Let's look at this. I want you to look at this chart with me in the audience. So the year-over-year metro level changes. It's interesting because the red areas are all areas that were super duper hot for a while, right? We're seeing Florida, Texas, Phoenix. These were the areas that were sizzling just not long ago, and now they're starting to come down. Is that typical?
Yeah, it is typical with housing. Often the growth markets are the ones that get the corrections or the deeper corrections. And so what occurred during the pandemic is those markets saw prices go up more. They had a lot of people move in, and they have just more new construction. And so as that migration is less of it's coming in, so they have to rely more on local incomes, that's created a demand shock, a greater one there. And the builders for multifamily and single family, they have to move that product. They're going to sell it. So if they have to discount it, do big buy downs, do whatever they need to move that product, they'll do it. And so it creates a cooling effect on the resale market as existing home sellers have to compete with the builders.
So here's the thing, though. I read somewhere where there's yesterday, I think, $700 billion in homes worth, for sale. Although I kind of like, say, come on, give me a break. But maybe it's what they, it's what they would like to get for them. $700 billion, and that's up over 20% from a year ago. At this pace, though, what happens? I mean, are we looking at a housing collapse?
So what we're seeing is more sellers markets becoming balanced markets, more balanced markets becoming buyers markets, and some of the places like Florida that was in a bit of a gully is now in a bit of a correction. And so we are seeing the market.
But you sound confident that it won't get worse. Like, it sounds like.
Well, there's downside risk in this market.
Okay.
Prices can fall. And this is one of those windows where there's a greater vulnerability to prices falling. It just takes demand coming down enough to where that can manifest. So big business, there's a big hue and cry. I think I was among them. I was among them about Wall Street buying up all the houses during the housing boom. A lot of times people were in bidding wars with Wall Street corporations or these large entities like Innovation Homes or Progressive Residential, and felt unfair, right? Someone bid $250,000 on their dream home, and someone on Wall Street bid $300,000. Now some are saying maybe they can come to the rescue and sop up some of this excess that we have. What's the role of these large institutions and these large big businesses that buy homes? So we saw an influx of institutional capital into single-family acquisitions during the pandemic housing boom. A lot of easy money rolling around, prices are soaring, rents are soaring. They chased it. And so they became 2% of the market at that time. That's pulled way back to where it's now a third of 1%. they're not buying much, and they haven't been buying much since the second half of 2022. They don't like the returns they can find in the market. Some of them are a little worried about some of the downside risks.
A lot of people are saying, they bought all the mobile homes, they jacked up rents. They bought all the cheap, low-hanging fruit homes, starter homes that a young family may otherwise have bought. They bought it and they jacked up the rents, and that prohibits a lot of young people from ever achieving the American dream.
I think they're downstream of what the overall reason was. There was so much money that came into the economy. Right. Ultra low rates, capital markets are humming, and it had to go find returns. And so I think maybe at a margin, maybe they played a role,
right.
But they're a part of a bigger movement of what happened during the pandemic.
So real quick, I've got less than 30 seconds. The Federal Reserve being criticized, rates are far too high. Should the Federal Reserve take into consideration what's happening in housing when they make their next rate decision?
Well, I think the thing with the long-term rates, like mortgage rates, sure. It's hard to say if the Fed cut some, how much that would impact the long-term rates.
I own an accounting firm, so if your business needs bookkeeping and accounting services, click on the link below for a free consultation. Now, let's take a look at this article from Business Insider titled, "There's a record of 700 billion of homes for sale in the U.S. Here's why the market is still frozen." After the worst year for home sales since 1995, there are a scant few of signs of life in the market. Even a record amount of unsold property hasn't lured buyers. According to Redfin, data released this month, sellers in the U.S. are sitting on 700 billion of unsold housing stock, the highest dollar amount ever. Going by the number of homes for sale across the country, inventory is at a 5-year high. Also, 44% of listings, or about 331 billion worth of home for sale, have been on the market for over 60 days, the highest share since 2020. So, where are all the home buys? Rates and prices aren't budging. It's not the usual order of event. Often with a deluge of inventory, prices edge down. They are still creeping higher. In April, Redfin said prices rose 1.4% nationally, even as the number of homes for sale jumped almost 17%. House hunters are only buying if they absolutely have to, and even serious buyers are backing out of contract more than they used to, a Redfin real estate agent in Denver said. Apart from prices, the other factor is mortgage rates. They are still too high for most buyers to stomach. The 30-year mortgage, which is tied to the 10-year Treasury yield, has barely budged this year. It's hovering just above 7%. And the top forecasters expect the rate to end this year only slightly lower. Goldman Sachs analysts last week said that they see the rate for most popular home dipping to 6.7% by year-end from 6.9% currently. After analysts initially predicted rate to cool this year as inflation abated and the Federal Reserve loosened monetary policy, forecasts have jumped again. That's because of the uncertain impact of Donald Trump's tariff policy has led to repricing in the bond market and scrambled prediction for the Fed to cut rates. Market now see the Fed to cut rate in 2025 coming in September, according to CME Fed Watch tool. Economic anxiety. A gap between the soft and the hard data points have been a big theme this year, with the weak consumer sentiment and inflation expectation at odds with the backward-looking data that the Fed used to inform policies. The general feeling of anxiety stems from things like tariff, the path of inflation, and the overall economy is fueling the weak demand in the U.S. housing market. Zara will continue. First, bond market volatility directly increased the difference between 30-year mortgage rates and 10-year Treasury yield, pushing mortgage rates up. 7% average interest rate is way too high for the local home buyers to purchase. I do see a sharp decline in Florida and several other states. Housing affordability has been the worst on record. And let me know what your thoughts below. That's it for today, folks. Thank you for tuning in. Don't forget to like and subscribe to the channel. I am a professional bookkeeper, so if you need bookkeeping and accounting services for a small business, please click on the link below for a free consultation. Thank you.